how to predict the next market pullback. Using the rule of alternation, if wave 2 is sharp, wave 4 will be complex. Always stay a step ahead.
Welcome back to Day 6 of our Explainer series. If you've ever felt like the market is just this chaotic mess of random price action trying to steal your money, well, today is going to be a massive light bulb moment. We're taking all that chart noise and transforming complex Elliott Wave guidelines into a highly predictable, fully executable trading algorithm.
So how exactly do you predict the next market pullback? Let's dive right into this universal trader pain point, getting completely faked out. You know the drill, right? You enter a great trade, momentum's on your side, and suddenly the floor just drops out. You watch with sweaty palms as the price plummets, hits your stop loss, shakes you out, and then, infuriatingly, rockets right back up to your original profit target. We have all been there. But today we're totally reframing that challenge. We're taking pullbacks from an anxiety-inducing guessing game and turning them into a strict, rule-based deduction. Here is our tactical syllabus for this explainer. We'll start with predicting the next pullback, then dive into the rule of alternation, look at how that applies to price and time, and then pattern types. Finally, we'll wrap up with how to trade all of this with absolute precision.
Section 1. Predicting the next pullback. And really, this all starts with understanding the fundamental reality of market cycles.
The market actually spends about 80% of its time in a corrective, sideways, choppy state, and only 20% in clean, clear trends. By definition, pullbacks are simply a price reaction against that primary trend. When impulsive waves, those are your waves 1, 3, and 5, surge in the direction of the overall trend, the market eventually has to take a breath. These exhales, the corrective pullbacks in waves 2 and 4, are exactly where market psychology splinters. Amateurs get trapped here. They panic, assuming a massive trend reversal is happening. But professionals, they stay completely calm. They know the trend is just taking a break, and they use these pullbacks to capitalize on heavily discounted entries. Knowing what these pullbacks are gonna do before they do it, that is your greatest structural advantage.
Which brings us to part 2, the rule of alternation. This is the absolute key guideline that strips the guesswork out of the game and gives you that incredible structural edge. The crucial point here is understanding the core definition. The guideline of alternation dictates that in any 5-wave impulse move, wave 2 and wave 4 absolutely must be noticeably different. They have to differ in price, time, or pattern type. Think of the market like a giant pendulum. If it swings wildly and sharply in one direction for its first correction, its next corrective swing is going to behave completely differently to balance out that energy. Meaning, if you want to accurately predict what wave 4 will look like, you simply study what wave 2 just did, because they have to oppose each other in at least one structural way.
When you analyze a valid impulse wave, the pullbacks at wave 2 and wave 4 have totally distinct opposing personalities. One might be vicious and fast, while the other is slow and grinding. That signifies a really healthy trend. But if you map out a chart and those two pullbacks look like identical twins acting exactly the same way, you aren't in a true impulse wave at all. You're likely caught inside a massive, choppy corrective sequence. And that is a huge red flag that your wave count needs an immediate reevaluation.
Now, to effectively anticipate this corrective behavior in real time, we've got to break this concept down into its 3 executable variables. These are your 3 pillars of alternation. First up, price, which is essentially a battle between deep and shallow retracements. A deep plunge reflects pure panic selling, while a shallow dip shows eager buyers stepping in early. The second pillar is time, contrasting fast, violent drops with slow, agonizing consolidations. And the third is pattern, measuring simple, straightforward structures against incredibly complex, multi-layered movements. Moving on to Section 3, alternation in price and time. Let's see exactly how we can take those first 2 pillars and turn them into a strict mathematical framework.
This is where we apply basic if-then conditional logic using Fibonacci levels. Say you have a deep 61.8% retracement. That means the market just wiped out more than half of its previous gains, a deep, terrifying plunge that shakes out the weak hands. If that happens violently and fast, in wave 2, the market is basically screaming at you that wave 4 will be the exact opposite. You can mathematically expect wave 4 to be a shallow 38.2% crawl that takes significantly longer to unfold. One is a sudden shock, the other is a slow bleed. Anticipating this difference is exactly what keeps you from abandoning a winning position prematurely.
Section 4 covers alternation in pattern type. This is the third and final pillar of our alternation framework, focusing on geometric opposites. Alternation manifests profoundly in the actual geometric shape of these pullbacks. Let's simplify some of the core Elliott wave jargon here. If wave 2 is a sharp ABC zigzag, which is essentially just a quick, brutal three-wave plunge straight down, then you should fully expect wave 4 to be a prolonged sideways flat or triangle pattern. These are complex, horizontal structures that take their sweet time building a broad base for the next move higher. Geometrically, they perfectly oppose one another. You've got sharp and vertical versus complex and horizontal.
Notice how a deep price plunge in that first pullback perfectly sets the stage for a sideways, grinding pattern in the next. The deep dive of Wave 2 reclaims a massive chunk of the previous rally, hitting those lower Fibonacci support levels. But by the time the market reaches Wave 4, the psychology is completely shifted. Buyers are way more confident now. So instead of another deep dive, the market just drifts sideways in a complex pattern, stubbornly holding on to most of its gains. That is price and pattern alternation working together in absolute perfect harmony.
Finding perfect alternation gives a trader immense confidence. When a wave 2 is sharp, quick, and aggressively deep, and the subsequent wave 4 turns out to be complex, time-consuming, and incredibly shallow, well, it leaves absolutely no doubt about the underlying momentum of the trend. When you spot all three pillars, price, pattern, and time, alternating flawlessly in the wild, it is the ultimate confirmation that the market is gearing up for a massive wave 5 push. It's exactly the setup professionals wait so patiently for.
Finally, Section 5, Trading with Precision. Let's synthesize all of these guidelines to make sure you avoid the common pitfalls that completely ruin amateur wave counts.
Now, alternation is an incredibly powerful guideline, but you got to remember, it operates entirely within a framework of unbreakable laws. These are not suggestions. If you break them, your money is at serious risk. Rule 1. Wave 2 can never end beyond the start of Wave 1. Rule 2. Wave 3 is never the shortest impulsive wave. And Rule 3. Wave 4 cannot overlap into Wave 1's price territory. The market just isn't a place for flexible guessing when it comes to these core principles.
That overlap rule is usually where traders get caught trying to force a narrative. For instance, if your supposed Wave 4 drops so low that it breaches into the prior peak of Wave 1's price territory, your count is totally invalid. You have to immediately abandon it. It literally doesn't matter how beautiful the alternation looked up until that point. You cannot force the market to fit your bias. If a core rule is broken, step back, reset your perspective, and start over from at least 3 waves back.
There's a really distinct tension between strict rules and market fluidity, and mastering that tension is the hallmark of a professional trader. As our source material emphasizes, Elliott Wave is decidedly rule-based. Experienced traders adhere religiously to the core rules we just discussed, but they remain remarkably flexible when the market structure naturally evolves within those boundaries. Merging a strict adherence to those core laws with the conditional logic of the alternation guideline is exactly how you map high-probability support zones in real time without losing your mind.
So, the next time the market pulls back, remember that the clues are already sitting right there on your chart. You just have to look at the previous wave. Will you let the next corrective wave fake you out in a panic? Or will you use the rule of alternation to predict it before the trap springs? The market doesn't have to be a guessing game. Thank you so much for joining me for this explainer, and happy charting.